Why is the Chinese stock market waiting for a collapse? China issues new bonds to prop up economy as global investors free at unprecedented pace. The World Bank has lowered China's economic growth forecast for 2024. Investors are dumping Chinese stocks despite Beijing's attempts to boost economic growth. The outflow of foreign funds from the Chinese A-share market has entered an unprecedented stage. The main reasons for the outflow: the economic downturn and the lack of convincing measures on the part of the authorities. Chinese authorities are facing challenges such as growing tensions between China and the United States. Beijing is trying to strengthen the falling stock market and stimulate economic growth. Temporary measures, such as intervention in stocks or policy incentives, do not change investor sentiment. Chinese investors are also experiencing a growing lack of faith in the future of the country's economy. The defeat of the Chinese stock market. China's capital market, which was estimated at $13 trillion at its peak in December 2021, has since shrunk by a third. Hong Kong shares fell on Friday, ending 3 days of gains, as investor sentiment soured amid concerns about deteriorating US-China relations and profit-taking after impressive gains this week. Shares of Wuxi Biologics and Lenovo plummeted. US sanctions on China may have a negative impact on the Chinese stock market, as they may cause uncertainty and deterioration of trade relations between the two countries, which will affect the investment climate and the growth of the Chinese economy. For example, in 2019, shares of the Chinese telecommunications company Huawei were excluded from some US stock market indices due to sanctions, which led to a decrease in their value and negatively affected the overall state of the Chinese stock market. Over the past 10 years, the Chinese stock market has demonstrated multidirectional trends, reflecting both positive and negative aspects. In the early 2010s, the Chinese stock market experienced a boom, which led to higher share prices and increased investment activity. However, in 2015, there was a sharp market collapse caused by large stock sales and lower oil prices, which led to the collapse of the securities market in China. The following years were marked by attempts to stabilize the market and introduce regulation to prevent such situations. In the following years, the Chinese stock market continued to show volatile dynamics, reacting to domestic economic and political events, as well as to global market trends. Since 2020, there have been noticeable positive signals with the recovery of the market after the outbreak of COVID-19 and economic stimulus measures that supported the growth of Chinese stock markets. In recent years, trade disputes and tariff wars between the United States and China, as well as changes in legislation on auditing Chinese companies, have had an impact on Chinese stock markets, and shares of Chinese companies traded on American exchanges. Until recently, China's technology sector was one of the most attractive for large investors. Now the reality is changing. But the situation has changed radically in a short time after the Chinese authorities began their policy of pressure on these companies. Large investors from the Asian continent are giving up a significant part of their shares in major players in the sector. Big investors leave their investments in the technology sector for various reasons, but they are all equally dangerous. One of these reasons is the policy to combat coronavirus. However, this is a temporary problem that is likely to be resolved. For a longer period of time, the behavior of government agencies in relation to certain types of business may become a problem. Some companies have grown so much that the government considers them a threat to stability. As a result, Beijing is taking steps to weaken technology companies and limit their scale. In such circumstances, investors lose interest in companies whose future is controlled by the government. Most of the responsibility for the speculative stock market bubble in 2015 lies with private Chinese investors. During the period from February to June, the stock rose sharply by 68% and then fell by 49% over the next 6 months due to gambling by Chinese investors. Indeed, most of the shares in the domestic stock market are owned by Chinese investors. Although it has become easier for foreigners to invest in China, they still control less than 2% of the total stock. So it is not surprising that many people think that the Chinese own a large number of shares in companies in their country. However, The reality is that compared to their counterparts in other countries, the Chinese invest extremely little in stocks. According to the chart presented, cash accounts for 72% of all household financial assets in China, which is 5 times more than in the United States, 14%, and twice as much as in the EU, 36%, provided that the data does not include real estate assets. Compared to developed economies, stocks and funds account for only 9% of Chinese households' assets, which is significantly less than that of US households. In short, compared to developed countries such as the United States, Singapore and the Eurozone, Chinese citizens are not investing enough in stocks and funds at all. Thus, Chinese citizens have a lot to catch up on. According to analysts and financial managers, Chinese stocks are likely to continue to fall due to the ongoing turmoil in the real estate market, which poses a threat to the economic recovery. They warn that political support is not capable of changing the situation. In 2024, the market is likely to remain volatile and limited due to the lack of strong catalysts, and long-term investors are likely not to return due to a lack of clarity about China's intentions in solving problems and stimulating future growth. In recent weeks, political support from Beijing has been more intense. The authorities tried to cancel the 3 red lines and called on banks to provide more financial support to troubled developers. The Chinese yuan is also starting to recover from a 16-year low, thanks to stronger fixings and seasonal factors. However, Maurer of HSBC warned that easing stimulus measures may not be effective. Strong government stimulus doesn't make much sense unless there are fundamental factors. The role of politics may be mainly to prevent major financial risks, and, in the end, the economy still needs to naturally find the bottom, she said. However, some bargain hunters may come back hoping for a recovery, given the low valuations. The average price-to-earnings ratio of the components of the MSCI China Index was 9.4 times, which is the lowest in 5 years, and about half the level of the SP 500 index. Fund managers UBS, Fidelity and Invesco are among the newly transformed bulls betting against. The Chinese stock market is expected to collapse due to the flight of large investors and due to unstable relations with the United States. Again, America rules the world. Besides, Chinese investors invest very little in their country's shares, due to which the economy is not stable. Write in the comments what you think about this and be sure to share this video with your friends. Also, do not forget to like this video because I am trying just for you, and do not forget to subscribe to my YouTube channel. Because here you will be pumped in the economic understanding of our world. A new video in 2 days. Bye to everyone.